We're excited to be together for our first event together as Wealth Cycle Advisors. Hopefully you've gotten some communications from us about the new group that we've put together with me, Emmett Corboy, Josh Fisher, James Kometz, and Kevin Kelly. All of us have been working together for a few years now, and we decided to just work together more formally and more collaboratively, so that we can not only do things like today in terms of bringing more educational webinars and educational events to our clients, but also just a number of different things that we'll discuss in the future as well. So a couple of items as far as housekeeping goes. The information today that we'll cover: key financial data for 2024. We know that a lot of times at the start of the year, people come out with New Year's resolutions, and whether it's health focused or ridding bad habits, a lot of times those kind of come down into financial resolutions as well, and can be financially focused. So we wanted to kind of present at a high level just some new information and new things to keep in mind in terms of different limits, different numbers for 2024. So we'll go pretty high level on a lot of different things, and we'll try as best as possible to not get too granular or too caught in the weeds. One thing I will say is we'll talk about different things pertaining to taxes. Disclaimer: we are not tax advisors, we are not tax professionals. Should you have specific tax questions, certainly reach out to your tax advisor for information on that. But we can certainly kind of discuss and answer generic questions there as well. We'll be together for maybe about 30 minutes or so, and as we go through this, we encourage you to jot down notes. If there are items that come to mind that you're wanting more information on, certainly follow up with us kind of after the event as well. And feel free to use the Q&A function in your meeting here as well, and we'll answer questions as we can kind of throughout the event, as well as wrapping things up at the end here as well. So without further ado, I will let Josh Fisher kind of lead us off here.
All right. Well, good afternoon, everyone. I'm going to start off by talking about some of our 2024 tax brackets and the key rates to lead things off. I know we probably could have picked a better time to dive into this topic. I just want to maybe apologize in advance. It's pretty number heavy, and that's why we're going to try to keep it as high level, and just know that you all are in different circumstances with related to your taxes and things of that nature, but just try to help it be educational and keep things moving along. This year for 2024, we'll continue to have 7 federal tax rates. They'll actually be the same as they were in 2023, with a 10, 12, 22, 24, 32, and 35. And then the last and highest bracket is 37% as far as those tax rates go. What has changed this year is they've just indexed for inflation the income brackets where those tax rates do apply. I think overall the change has been about a 5.4% increase to the income levels that we would have looked at by comparison to last year, and I'll show you that in a slide in just a moment. When we look at a basic 1040 tax return, on the front page just below where you put your information and you list your dependents, in this income section, we want to kind of scroll down and focus on the bottom where you look at line 15, and we're looking at taxable income, because that's really what's going to determine, what rate of taxes you actually pay. I know there's a lot of terminology when we talk about taxes, like what's my effective tax rate? What's my marginal tax rate? Well, first and foremost, we want to figure out what your total income for the year is. And so that would include wages, pensions, IRA distributions, anything as far as interest and dividends from investments or bank accounts, and then also taking into account, the adjustments that they make. This year as well, we'll cover how the standard deduction has also changed. And so as we get down to making those adjustments with the adjusted gross income, taking into account whether you itemize or take a standard deduction, we will land basically on line 15, which is the taxable income. We'll mainly look at single and married filing jointly for our main tax status filings. But as you look down the list here, you can see those main tax brackets of 10, 12, 22, 24, 32, 35, and 37%, as I had mentioned. And you'll notice that basically for each range of taxes, as you kind of move up, our tax system is what we call progressive. So as your income rises, you're paying a higher percentage of tax on the next level of income or each higher dollar of earning that you look at. So we can see here that anything from basically $0 to 11,600 is at that 10% level. And then our highest level, if you're earning over $609,350, you're paying about 37% on every dollar that you earn above that threshold, which is, the highest that it's been. Right now, as things are set, these tax brackets should remain in place as they stand through the end of 2025. In 2017, there was a key tax law change that was called the Tax Cuts and Jobs Act of 2017, where all of these rates were effectively higher. You didn't have a 12 and a 22, you had 15 and 25, and the highest end of that tax bracket was 39%. So without any sort of reform, we'll continue to expect these sort of rates through the end of 2025 unless they make further changes. But what we do anticipate seeing changes of are the income ranges, as I had mentioned, each year. And that's important because obviously we felt inflation more in the last few years than we have in any other prior years. So what can happen pretty quickly is that if tax brackets aren't adjusted, you could find yourself in a higher tax bracket inadvertently just because of payroll or wage hikes and just increase in your base salary. So we just kind of call that a tax creep, because you can just pop into a higher tax bracket inadvertently unless they adjust those numbers basically for inflation. If we look at an example here, and let's just take a single person, that maybe makes $110,000 a year. And I just wanted to point out that in this case, your income, is based on, again, how much you earn. So as we go up through those different tax brackets, I just want to point out that, if you're single and you made $110,000 last year, you don't pay a flat 24% on that 110,000. So you're not going to get a bill from the IRS that says, hey, if we flipped over that tax return that we looked at in a previous slide, on the next line, I think it's line 16, where we said line 15 was your taxable income. Line 16 says this is the taxes you owe. So it's a really important number to know as well. So that number is not going to be 26,400 or 24% of 110,000. Basically, as this person was progressing, you would see that they would pay, 10% on that first 11,600, 12% on the next, and all the way up. So effectively, that person making 110,000, their tax bill is really going to be probably about $19,440. So again, it's a big difference, but we just want to highlight just the conception of how the taxes work and how they're basically calculated in that general sense. A lot of times what folks look at is when they look at that higher bracket, in this case, let's say 24%, that's what they call your marginal tax bracket. So it's kind of like, where does my income fall on the top end? So usually when they say marginal taxes, it's like, what tax rate am I paying on my most recent last dollar of earned income? So in this case, this particular person, if they earned, $110,001, that next dollar is going to be 24 cents of federal taxes owed on that $1 earned until they move into the next tax bracket. The other thing to note is just that with respect to your taxes, as I talked about line 15 and line 16 of your tax return, if you were to look at old returns, you could effectively calculate what is your effective tax rate. And all you would need to do is just divide the total income that you have on line 15 into the taxes owed on line 16, and that would tell you what your effective tax rate would be. Because remember, after we have our earnings, and let's just say again, 110,000 in this scenario was just through wages, for example, or a salary, that person's still going to have some either itemized deductions or a standard deduction to kind of reduce that number down lower. So it could effectively push them down into, the real tax rate that they're actually paying for that particular tax year. So as we transition, I won't go into the same level of detail in the example, but this is the tax rates that we're looking at for married, filing joint, or surviving spouses. So, in a general sense, we can still see the same tax rates. It's just that as we account for two individuals in the household because they might be married, that higher end basically goes from 731,200 at the 37% rate. And then on the low end, you're paying 10% on everything under 23,200, as far as that goes. Now, just looking at a comparison, and I don't mean to flip your brain around because I went from highest to lowest in these scenarios, but just wanted to give you kind of a summary comparison of the different tax rates as they changed from last year to this year moving forward for 2024. And you can kind of see that basically the numbers have changed just slightly. Again, it's around 5.4% that they've kind of averaged up to say, look, we're accounting for inflation. So even this year, as you may have gotten some pay raises and things of that nature last year, that could be to your benefit this year as they account for, higher income ranges and things like that. So when we talk about standard deductions, remember that, with the changes in tax laws, one of the other key transition points for the Tax Cuts and Jobs Act of 2017 was to basically increase the standard deduction for most households. Mainly so that many people wouldn't have to really worry about itemizing. I know that's not going to be true for everybody, and some folks still do that, but it was just to kind of simplify the tax processing overall. So when you submit your tax return, so in this case, what we can see here is that folks who are filing married jointly, your standard deduction is going to be 29,200. Single or married filing separately is going to be 14,600. Head of household would be 21,900, or if it's just a dependent filing their own return, it would be 13,000. That essentially that's just a direct write-off of the income that you would be earning for that year. When we say write-off, it's just a subtraction of the income on paper. If you are blind or over age 65, they actually provide an additional part to the standard deduction of $1,550 per person in the household that would apply for. Or if you're blind or over age 65, unmarried, and not a surviving spouse, it's $1,950 for the year. So again, it's just kind of a little extra icing on the cake for that deduction if you are someone who falls in that particular category that you would be able to take in addition to the base standard deduction. And for this year, if you have children, any children under age 17, there is a child tax credit of $2,000. If you completed your tax return and you basically broke even, if the child tax credit was applicable, up to $1,700 of that could be refundable, which is pretty cool because it is a credit. So that is a dollar for dollar reduction of your tax liability. So in this case, if you owed nothing, it could put you in a situation where you actually got $1,700 back on the high end. So that's pretty cool when you look at that. And then as we look at income phase outs for the adjusted gross income, it would be $400,000 if you file jointly, and then $200,000 for all other filing statuses to basically say, hey, does the child tax credit apply for this particular household to be able to take advantage of it? One thing I will note is that in recent news, there has been some bipartisan support of a bill that's supposed to go into the full chamber for a vote to essentially increase the child tax credits back to where they were in with COVID, to basically provide a little bit more balance to that. That hasn't been voted into law yet. So if that does change, we'll make sure that everybody's aware of that. But it's again expected within the next week and change to say if that hits the floor, and then that would be retroactive for 2023 to be able to take advantage of it. So don't run off and get your taxes filed too quickly if you're in a hurry to do so. That way you don't have to do an amendment or something crazy like that. Now I'm going to turn it over to James to let him cover capital gains and qualified dividends.
All right, thanks, Josh. So yeah, we'll start with capital gains, and just so we're all on the same page, capital gain is when you sell an asset or investment at a profit, obviously causing a taxable event. So if you held that investment for less than 1 year, that's a short-term capital gain. You'll pay taxes on your ordinary income. But if you held that for more than 1 year, you'll pay capital gains tax rates, which are more favorable for most. So here on the screen, you'll see what the rates are: 0, 15, and 20% tax rates. Those three stay the same. The income just was inflated this year a little bit. So if for single under 47,000, you'll pay 0%. $47,025, you'll pay a 0% tax rate. If you're filing joint under $94,050, you will still be in that zero tax rate. If you are above 518,900 single or 583,750 for joint, you'll be in the highest bracket at the 20%. And if you're somewhere in between, you most likely will fall in that 15% tax bracket. There also is what's called a capital loss. So if you do sell something and it is down, then you can deduct up to $3,000 carry forward each year or offset some gains. So one strategy you may look at here with capital gains is if you're selling something that's up, to tax loss harvest and maybe find something that's down as well to offset some of those gains. Then next we'll look at a couple other taxes here. The first one's doesn't apply to many people, but the alternative minimum tax, or AMT for short. This is basically a tax the government applied to, as they say, for high earners to make sure they're paying their fair share. Typically comes into effect if somebody is a high earner but also has a lot of deductions. So if you are earning under for married filing joint under 133,300, anything below that you're exempt. If you earn more than that, you may be subject to AMT. 85,700 for single. I said typically doesn't apply to many people, but it's a separate formula they run to make sure if you are above that, you may have to pay some additional AMT tax. The other one that I'll briefly touch on is it's net investment income. Josh, you can go to the next slide, please. That's back. Yeah, there you go. It's a 3.8% tax that's applied to either the lesser of your net investment income or your modified adjusted income. This is kind of similar to before. It's for high earners. If you have more than 200,000 in investment income, you could have this additional tax of 3.8%. Your net investment income typically is going to include taxable interest, ordinary dividends, capital gains, things like that. Doesn't apply to many people, but for married filing joint, 250,000, single is 200,000. Yeah, next we'll get into some gifting in estates. So this was also adjusted for inflation. So the maximum annual gift exclusion is now 13,610,000, up from 12,900,000, I believe. The other notable adjustment here was the annual gift exclusion went from 17,000 to 18,000 a year. So a lot of our clients, as they will like to gift each year, each person can gift up to 18,000 per year to a person without it affecting their taxes. And also You have unlimited gifts available for if it's going towards education or medical expenses. So it might be a good idea to try and give some assets if you've accumulated as well to help save on some taxes down the road. Next thing we'll touch on is some credits, some education credits. There's two main ones here. One called the American Opportunity Tax Credit, and then the other is the Lifetime Learning Credit. And this first one, the American Opportunity Tax Credit, it's a little more favorable or valuable, but it's a little bit harder to qualify for as well. So some of the restrictions here, you have to be pursuing a college degree, not just taking a class somewhere. You have to be enrolled at least half time, which is going to be different per school, but they have a criteria to be enrolled at least half time. And you can only use this for the first 4 years of secondary education as well. So if you're in a 5-year program or take longer than 4 years, you're not able to use this credit more than the first 4 years. Then income restrictions, you have to have a modified adjusted income of lower than 80,000 if you're single or 160,000 if you're joint when filing for the credit. But the way the credit works is you get 100% of the first 2,000 of expenses covered, and then you'll have 25% of the next 2,000 for a total of 25,000 maximum credit. So that means essentially if you have 4,000 expenses, you'll get a $2,500 credit if you qualify. And 1,000 of that is actually refundable as well. So if you don't end up owing taxes, you could get up to $1,000 as a refund as well with that credit. And then the next will be the Lifetime Learning Credit. This one is a little less restrictive. You don't have to be seeking a degree or the half-time enrollment requirement. So you could be taking a class just for personal development or for a certification or something along those lines. And you could qualify for that. And you don't have to, you can use as many years as you want. It's not just the first 4 years after secondary education. And no limit to how many years you use it. So if you take one class each year, you could use this credit each year. The income is a little bit more restricted though. So 56,000 of adjusted income for single and 112,000 for if you're filing joint. There is a phase out between 66,000 and 132 to get partial credit. But the way this one works is it's 20% of up to 10,000 in expenses for a max of 2,000. So to kind of compare the two is if somebody has $4,000 in expenses, the first one, the American credit would have been 2,500, where in the same 4,000 expense will be 2,000 for the lifetime learning credit. So a little bit more favorable, or I'm sorry, it would only be 800 with the lifetime learning in that example, 20% of 4,000. So a little more favorable if you can qualify for the American credit. And then next, we're going to touch on 529 plans. So 529s are a great way to save for college expenses. The first 4,000 per 529 gives you a state deduction. But then on the distribution side of things, you can take 10,000 a year if it's applied towards K through 12, which is a relatively newer law they passed. And then for distributions for higher education, it needs to be a qualified expense to avoid any kind of taxable event. They also now, starting this year, are allowing, I believe it's up to $35,000 a year rolled into Roth IRAs from 529 funds that are not used. So some good features with that have been passed recently as well. And then we will pass it over to Kevin now to talk about some retirement contributions.
Awesome. Thanks, James. So yeah, I know we've gone through a lot of numbers here. So we've got a few more here in terms of retirement plans specifically that we're going to talk about. So the first one is going to be your employer-sponsored retirement plans. So these are obviously important for not only talking about how much we could potentially save in terms of taxes for the year, but also how much can we actually start saving for retirement? Because I know that's a big topic for all of us of when can we officially retire. So a couple of important numbers to take a look at here. The defined contribution plans of 69,000. That's both your contribution as well as your employer's contributions. That's important. It went up about 3,000. It was 66,000 last year. It's up to 69,000 this year. Also, you see the 401k, 403b, 457 line there. That number did increase as well to 23,000, which is up about $500 from last year. It was 22,500. Obviously, that just depends a little bit on who you work for and what sort of qualified plan that you do have. But all of those, you do get the 23,000, the extra 500 this year. The catch-up provisions for anybody over the age of 50. You do still get the 7,500. That did not change. It's the same as it was last year, as well as the simple plans with the 16,000 or the catch-up provision of 3,500 that you could add if you are over the age of 50. So the other types that we can obviously talk about, and I know you've probably mentioned with your advisors before, is the IRAs. So the IRA limits in terms of contributions did go up again this year as well. So you'll notice that they are up to 7,000 instead of the 6,500 it was last year, and you still do get that $1,000 catch up if you are over the age of 50. A couple things to keep in mind here, some misconceptions that you might see with your IRAs is lots of times we see that people think that if they do have both a traditional and a Roth IRA, that they're able to contribute 7,000 each, but it is 7,000 total. So if you do have both traditional and Roth IRAs, just remember that it is 7,000 total between all of your IRAs, not per each one that you may have. You'll also see the income limits. I know we've talked a lot about, in terms of different where you are income wise. Obviously, this is something if you think you're going to have a much larger income for the coming year, that's something you're going to want to have a conversation with us about in terms of, are you going to be able to still contribute to the plans that you were potentially contributing to last year, as well as if there's anything lifestyle wise that's changing. Maybe you're getting married and you're going to start filing jointly, that sort of thing. You want to make sure you have those conversations with us to make sure that we're not contributing to either contributing to accounts that we're not able to, or just not getting the actual benefits from those IRA accounts. So and then the next thing I believe we're going to be talking about is so different health accounts. So there's HSAs as well as long-term care premiums. So we'll talk about the HSAs here first. I know some people know quite a bit about HSAs if they have the ability to contribute to them. The downside to HSAs are that you have to have a high deductible health plan to be able to contribute to an HSA. And lots of times your employer can help you with that, and your employer offers that through them as well if that's something that you are eligible for. But if you are lucky enough to be able to contribute to these, what's nice about HSAs is they are the rare 3 tax advantaged accounts to where you can contribute to it pre-tax. So it lowers your taxable income for the year. It also, even though it is a savings account, you are able to invest in it as well. So any of those gains that you get while it is growing inside those accounts are all tax-free. And then as long as you take anything that you take out in terms of distributions, as long as it's a qualified medical expense, you do get that tax-free as well. So it is one of the very few accounts that are out there that you do get the 3 tax advantage savings when it comes to these accounts. And if I know sometimes too, if with these HSAs, it can be a little bit confusing in terms of what actually qualifies as a qualified medical expense. But most of the time, whoever your HSA is through, they'll have a list for you to be able to take a look at that and see exactly, to make sure that you are taking, if you do take some distributions, that you are taking out for a qualified expense and you don't get penalized for that. And then the next one should be the long-term care premiums. So if you do have a long-term care policy, you do have the ability to deduct a percentage of your premiums. So that'll obviously just depend on, as you can see here, your age, as well as how much you are contributing in terms of your premiums. It's one of those things that a lot of people may not know about if they have a long-term care policy. So something you definitely want to have a conversation with one of us if that is something that either you're interested in looking at long-term care for the future, or if you do already have a policy, we want to make sure that you're taking advantage of these benefits as well. And then Medicare premiums. These obviously change every year. And if you are over the age of 65 and you do have the ability to begin getting your Medicare benefits, you see the premiums for this year, and they do increase based on your modified adjusted gross income, as well as whether you are filing single or joint. So just, in terms of knowing where you are on the spectrum and how much you are making. Obviously Social Security plays a part in that as well. If you've already begun taking your Social Security benefits as well, that can play a part in terms of what your overall premium might look like. And thanks, Josh. So the last thing that I'll be talking about is Social Security. So as you can see, the estimated maximum monthly benefit for Social Security this year is $38.22. So if you are anybody that's turning 66 this year, would have been born in 1958. What that means is that your full retirement age is 66 and 8 months. So just something to keep in mind there. We are in that phase of moving from 66 to 67 when it comes to your full retirement age. So if you're not quite there yet, or you don't necessarily know where your when your full retirement age is, we can certainly help you with that. But you can also see that in terms of your earnings, a lot of people don't realize that if they do take their Social Security, depending on when they take Social Security, there are some exemptions as well as some potential penalties if you do take it early. So as you can see, the $22,320, if you are under your full retirement age, that's the amount that is exempt. But anything that you earn over that, the IRS will take $1 for every $2 that you earn over that amount up until your full retirement age. So that's definitely a huge planning opportunity when it comes to determining whether or not you want to take Social Security early. You want to make sure you know exactly what the benefits that you'd be receiving, as well as the potential penalties that could come from taking it a little bit early. But with that, I believe, oh, no, we do still have the tax brackets here as well. So you can see that it obviously depends a little bit on how you're filing, as most of the presentation has been today. But a lot of people don't realize that your Social Security benefit is taxed. So just playing that, and having that as a part of your plan as well, to make sure that you understand exactly how much you're going to get in terms of benefit, but as well as how much is going to go to you in taxes, or just how much you're going to have to pay in taxes, as part of the overall planning that we can certainly help you with as well. And I believe I will pass it back to Emmett.
Awesome. Yeah. Guys, you did a great job kind of going through all this information. We talked about, the tax form 1040. We talked about tax brackets. We talked about, taxes on investments and capital gains. We talked about Medicare and Social Security, and just, contribution limits for all kinds of different accounts. And, there was a lot of information that we just went through and covered. And I hope that this is beneficial for, all of you in the audience here today. I hope that this helps to kind of, trigger some questions as you go and plan to meet with your tax preparers. And if you have questions about anything pertaining to maybe, your accounts with us at Statera, or just in general, as you're doing your tax returns for the year, we'd be happy to sit down and talk with you and kind of go through that information. And, if you're in search of a tax preparer and you need somebody, we're happy to make a connection as well. So one thing that you see here, this is the Key Financial Data 2024 card. You should have gotten this emailed out to you, and it was part of the registration for this event. If you'd like a copy of this, whether it's a digital copy or a hard copy, pretty much all the information that we just went through is on this 2-page PDF. And we are happy to either email that or mail it to you if you do need a copy. I'll also say we're hosting another event. Our plan is to do a webinar on the 4th Tuesday of each month at 1 o'clock. those times may change, as we see, kind of, pros and cons to different times. But our next event would be February the 27th. So you can go ahead and mark your calendars now. We're planning at that point to do a financial fitness checkup and may have some information in investing in an election year, as obviously 2024 being a presidential election year, that can always kind of present some questions there. So we've got some good information to cover in that space as well. So I don't see anything in the Q&A right now. If there are any questions, get them in there as quick as you can, as we'll be kind of wrapping up here. But was there anything else that Josh, James, Kevin, that you guys wanted to add at all? One thing I will say that, as Kevin was covering the HSA, and then right after that, something called IRMA, the income related Medicare adjustment, the HSA can really help with both of those spaces where it helps you on taxes now. So if you're, in your working years, you're looking for ways to save money on taxes, and you're in a high deductible, health plan, adding to an HSA, if you don't use that money now, you'll thank yourself years down the road, particularly if you're in a high tax bracket again during that Medicare timeframe, beyond age 65, when you're covered by Medicare. That HSA can come into play to help with, those additional Medicare premiums or just additional expenses that you have as well. So that can be, definitely a great financial tool, because like Kevin said, it provides that triple layer of tax benefits. Pre-tax going in, grows without taxes, tax-free coming out as well. So. All right, I don't see any questions in there, so I want to again thank everybody for taking time out of their day to join us today. Hopefully you found this information beneficial, and we look forward to talking with you very soon. Thanks.